Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Earnest Sweat. You ready? Let's dive in. Today we are speaking with Boris Wertz, founding partner of Version 1. Boris is an entrepreneur turned VC, backing mission-driven founders at the earliest stages. He's on the show today, however, as an LP. Boris has backed close to 20 emerging GPs over the past 5 years, and recently Boris innocently tweeted that he was looking to add 3 to 4 more GPs to the portfolio this year. Quote, DMs open. Within days, he had received over 200 decks. Be careful what you ask for. Boris, thank you for coming on the show. We're so curious to hear what you've taken away from this fire hose of GP outreach.
Great to be here. Thanks for the invite.
Thank you. You represent for us this LP archetype, which is the VC LP. We've seen many first-time fund managers are backed by more established VCs. And I assume the reasoning for some is access to early-stage deal flow, insider information. I'm curious, what's your reasoning and why do you invest in other GPs?
Yeah, so I think originally when I started about 7 or 8 years ago, it was really much more about giving back. There were people that put me into business when I was an emerging manager back in 2012 and helped me raise my first fund. And I thought when I met an emerging manager that I really liked, I just wanted to be a small part of that person being in business. I think over time, I realized 2 more things. The first one was I was just learning lots. I think in the emerging manager space, it's really where lots of the innovation happens. People that move very fast, create new models, create new positionings, create new offerings for entrepreneurs. And so it was just a great way for me to kind of stay connected and really close to where innovation happening in the venture market. And then over time, I think also I refined a little bit my investment approach and understood kind of good from bad deal flow. And I really think that ultimately, I think I'm in a great position to make good investments in the emerging manager space. And I think it can be a really good kind of return strategy. So it really evolved over time. But having said all that, it certainly VCs investing in emerging managers has become pretty standard now. There's lots of bigger funds that have their own programs or investing from the GP, and obviously much more professionalized than it was when I started, 7 or 8 years ago.
Boris, do you think there are wrong reasons for VCs to be investing in emerging managers?
No, I don't think it's wrong reasons per se. I think as an emerging manager, taking money from another VC, later stage VC, you just have to be clear about the intentions, right? And it kind of on the softer side, people want to build a relationship, and I think that's completely fine. Sometimes it has got much more structured these days, right? Where people ask for weekly pipeline updates and weekly calls, etc. And if you have too many of those, right, then that really takes away from your time making good investments and thinking about your own firm. So I think it's generally good intentions, but just be careful what you ask for.
Yeah, at that point, I work for you and you're my managing partner. I'm just at weekly
That's correct.
pipeline meetings.
Upload your CRM here.
Exactly.
Moving kind of to execution, is the money coming from you personally, or is it actually a part of your strategy at Version 1?
So the vast majority is coming from my own personal money. We have done some strategic investments in other funds. For example, we invested very early in some crypto funds in 2016, 17 when we wanted to learn. I think in general, we want to keep that apart. Kind of Version 1, our investors, our LPs pay us for making direct investments in startups, right? And it's not a fund of fund. And anything we do outside of that to build our network and learn, et cetera, should either come from the GP or from our personal kind of resources. And so that's how I think about it. But obviously, there's different models out there. Some other people have dedicated pools within their funds to invest in other funds.
And what's motivating you now to be interested in making 3 or 4 more GP level investments?
I think it's a really interesting phase in the same way that I would say in the startup ecosystem, you probably have some of the most passionate, hungriest entrepreneurs out there. Given that fundraising is really, really tough, kind of the opportunistic people have probably left the market. I feel the same way about kind of fund managers that are raising right now. The opportunistic people have left, but the people that have a truly differentiated strategy, have true staying power, really want to power through, really want to make that their career, really want to build a fund, they're on the market. And so at the same time, you have very minimal interest right now from lots of LPs and to invest in emerging managers. Everybody is going back to the existing franchises and branded kind of VCs. And so from that point of view, I think there's a real opportunity to back emerging managers that are hungry, that are smart, that are hustling, and at a time where there's not a lot of competition for backing these type of VCs.
Yeah. Anecdotally, a couple of my friends on the LP side are saying it's felt like an onslaught, the number of people who are showing up in their inbox asking you to fundraise starting now. Your tweet mentioned areas of interest: crypto, climate, deep tech, India. How come?
So I think it's very much kind of educated from our own thinking at version 1. So version 1 is a generalist fund. We're currently investing out of our 4th fund. It's a $70 million seed and pre-seed fund. And the way we think always about alpha is if we can invest in some of the best entrepreneurs that kind of build something in new markets at the start of a new technology wave, that's where it really becomes interesting, right? And so we continuously think about what are these new areas that are interesting. And the 4 you mentioned, crypto, climate, deep tech, India, are some of the really interesting new waves that we see out there. We invest in these areas at version 1, but we also I personally think that more can be done in these areas, and VCs that are kind of emerging managers that are specialized in these areas can actually put themselves in a great position to generate amazing returns over the next decade or so.
With the types of funds that you're investing in, which I believe are pre-seed and seed micro funds, how do you position the relationship for, is it a one-time engagement, or do you see this as something that you'd re-up in?
So I would say perhaps a little bit less formalistic, like an institutional LP that always says, well, if you back you in fund 1 or this fund, we definitely going to back you in the next and perhaps the 3rd fund from here. With some of the funds where I invested a little earlier, I'm now on fund 3. So I've had re-upped over time, but it really depends on a few things. Obviously, kind of how these funds evolve and kind of what I learn more about these fund managers. But secondly, and probably most importantly, is also how the size of the fund kind of evolves. Strong believer of small fund sizes drive outsized returns, right? And obviously, some emerging managers go on a very quick path of scaling up and go from what is initially a $20 million fund to a 70 and then a $150 million fund over fund 2 and 3. And that's obviously, great for them if they can do that. Probably not as much my own investment strategy. So that would be less of a fit going forward.
So Boris, do you think about what you can provide? And you talked about paying it forward. What else you can provide to these fund managers?
Yeah, listen, I think it always comes down to 3 things. Most important for every emerging fund manager is other LP introductions, right? And depending on the area, depending on the size of the fund, obviously I have a bunch of other LPs I can introduce them to. that was certainly a little easier, let's say 2 or 3 years ago than it is today. But I think I've been able to be really helpful to a bunch of my GPs in terms of raising additional money. I think the second thing is kind of having been an emerging manager, having learned over a little bit more than a decade on kind of how to build a fund, how to think through portfolio construction, all of the stuff that just takes time to mature as a VC. I think sharing that, and it's there's no formal program or anything like that, but it's certainly you connect with a bunch of your GPs over time and try to give them advice as these questions come up for them. And then the third one is much more on the purely operational side. Like as you grow, kind of fund administration, legal, CFO, et cetera, et cetera. I think there's just a lot of advice that can be shared there.
It makes me think of a friend of mine, Kanye at Kindred Ventures, always speaking about.
He's amazing.
Yeah, he's an awesome guy. Speaking about, are you an investor or a fund manager? And those are different things. And so getting a lot of people come in as investors starting a fund, but need to get that experience of how to be a true fund manager, which includes the operations and the LP management. So I wanted to continue on before you get, you sent the tweet. What was your mindset? What was the motivation? And kind of, what did you think? What did you expect the response was?
Yeah, I mean, so, I had been kind of relatively open about in that I was interested in investing in other VCs for some time now, but never really made it that public as in a tweet. And I thought, like, why not see what that unleashes? I certainly didn't expect that reaction. I thought I would get a few dozens inbounds, but not like hundreds, literally. So it just shows how many emerging GPs are out there right now raising funds. And it was definitely something that had gotten much more reach than I had ever expected.
Yeah. So I believe you got about 200.
Yeah, that's correct. Yeah,
200 GP decks. How did you sort them?
So I think there is one way was very quickly about fund sizes. I had a pretty clear idea about kind of fund sizes. So sub 20 million was one of the criteria. Secondly, I was very clear about what areas I was interested in investing. And we mentioned that before: crypto, climate, deep tech, and India. So lots of generalist funds out there that just had way too much overlap with what we're doing at version 1, and so it wasn't really of interest. And then thirdly, lots of funds that are in different geographies and kind of European funds, Africa, Southeast Asia, and while I'm pretty sure that there's amazing opportunities, I wasn't focused on that right now. So out of the 200, you can cut it down very quickly to perhaps 30 or 40 that actually fall into the criteria of what I was looking for. And then from there, it was a matter of looking at these 30 to 40 funds and saying, like, what feels differentiated, what is interesting, in what networks are they playing, et cetera. And then I had about 2 dozens of conversations where it was digging in a little bit more.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have industry expert and sponsor, Martin Armstrong, founder of Armstrong International, the global executive search firm specializing in financial services. Thank you, Martin, for partnering on the show. Martin, what is the origin story behind Armstrong International?
Armstrong International started when Goldman Sachs landed in London in 1987. And Goldman couldn't get anybody to work for them. Nobody was interested in working for Goldman Sachs because nobody had heard of Goldman Sachs. They wanted to work for sort of British banks like Kleinworts and Barings and people like that. And there was a very, very frustrated partner called Bob Steele, who who basically had me over to his office. He said, "Listen, I just can't get anybody who wants to come and work at Goldman Sachs. And, we're a serious bank." And so I basically started to recruit for Goldman Sachs for 10 years, placed over 150 people at Goldman Sachs, built Armstrong International on the back of that knowledge, and really absorb everything that I learned from that firm, which was, that talent is really, really important. And in those days, every single partner cared deeply about talent. Famous people like Bob Mnuchin, who was one of the first people I worked with in the US. These guys were really, really incredibly good at attracting great people, organizing those people properly, training those people. And it really got to a point, I remember, by 2002, having worked for them for 13 years and doing a lot of recruiting for them, the depth of the bench at that firm was, and still is, simply incredible. I mean, it was really incredible. And so that was the mother's knee that I learned at, the knee of Goldman Sachs, of how to be really, really good at recruiting people, and how important talent was. So that's where we came from.
No, it's everybody I know who's spent any time there. The people development piece of Goldman is kind of legendary. So I can see that you were part of that.
The thing I found frustrating, to be honest with you, was the 15 interview process. But that type of detail, that type of focus, really meant that they never made mistakes, or they very rarely made hiring mistakes. They were just really, really good at it.
Hard to get in, but once you're there, you really want to be there. It makes sense.
Great training.
And what does Armstrong International focus on today?
So today we focus on any financial services company to whom talent is important. Okay. And that tends to be venture capital companies, private equity companies, private credit companies, because in those companies, the quality of every single person is really, really crucial. We tend not to work for franchise companies in the financial services business. These are, where talent is less important and franchise is more important. We're less interested in that. But, where we come across an organization that has a real commitment to and wants every single hire to be crucial and to deliver the top line, that's something we're very, very interested in, and we like to work with. And we mainly like to work with founders if we can. We don't like it if somebody's delegated the responsibility of talent acquisition to a committee. We like it to be somebody who's a business owner or a senior person in the organization who wants to have the very, very best team around them. And the great thing about the finance industry and the venture industry is that, the quality of talent has a massive impact. It's kind of like football teams. So, if you don't have the right people and they're not organized properly, you're not going to be successful.
No, that makes me curious, Martin. What is the argument for having founders versus a committee manage hiring? Why is this so valuable?
I think it's a sense of ownership. So when I started Armstrong International, I had a mentor, a guy called David Ogilvy, who had an advertising agency. And I used to write to him, and he used to give me advice. And one of the things he said to me was, or he actually wrote it in his book. He didn't say it, but I read it and I talked to him about it. Was in all of your towns, in all of your cities, there are no statues to committees. Okay, and the difference between a founder and a committee is ownership. Okay, a founder is on the line. They are engaged. They are fully dependent upon every hire, and it's that kind of, it's the difference between, bacon and eggs. The pig is committed, the chicken's involved, right? So we're interested in the bacon guy who's really fully engaged, or girl, and who's really fully engaged and is absolutely committed to each hire. And we want to be held accountable. That's really what we really like, is when somebody says, something, if you mess up, it's going to cost you. And we like a corporate memory because, where we operate best is when somebody's saying, listen, I'm making Barbie. I only want Margot Robbie. Okay. I'm not interested in anybody else. It's got to be Margot Robbie. So we're interested in, you know, we're not interested in process recruiting where you're going down a list. We're just interested in saying who's the absolute best person for this role that's going to make the biggest impact on this role, and how deeply can we think about that? So
Yeah.
how do we really break this role down to human qualities that are going to affect the outcome? And we have qualities we're looking for in all people. We've got this thing called the Star Wars factor in our organization. It's called the Jedi, which is judgment, empathy, drive, and intellect. So we're looking for that in every single person. That's it. They're kind of universal qualities of talented people. But when you get into certain jobs, if you're into ops roles or revenue officer roles or finance roles, what you're really looking for are very, very specific talents. And the one talent that we're not so hot on, or that we're not that interested in, is leadership. Because if you have a really well organized, talented team, there's not a lot of need for that. There's just if you've got people who are well aligned in a structured organization delivering, you won't need a huge amount of leadership. So yeah, I don't know if that answers your question.
That's good news for anybody who's been brought in through Armstrong International. You aren't going to get leveled.
No.
You're the guy. You're in
Exactly.
charge. And I believe you also have a lot of experience filling board seats. Anything that's helpful for us to know about what we should be considering when filling some of these later stage boards?
I think that the most important thing is for people to know what a board is supposed to do. Okay. And you'd be surprised how many people we place on boards where they don't really know what a board is supposed to do. Okay. So the board is supposed to be there to look after the interests of the stakeholders. And the most important thing in that scenario is transparency and process. Okay. So, and that the responsibilities of those elements of process are handed out to different board members. We find that a lot of the time, some people go on boards and they think they're kind of in a quasi-executive role. And that's not good. I think that if you're going to serve on a board, your job is to hold the CEO and the management team accountable for their strategy. Now, in some cases, one of the things we don't like is when we see the chairman and the CEO being the same person, because that's in that scenario, you're marking your own homework, right? So we like division between the board and the executive management team. We see the board there as to hold the executive management team accountable and to deliver on the strategy. And, we constantly remind board members and people going to serve on boards that they are there for the stakeholder. They're not there for the management team. They can empathize with the management team, but they're there for the stakeholder. And that's very, very important to remember, because if you are truly there for the stakeholder, then you don't have a problem communicating with the stakeholder on your fears or concerns about a management team. And that's something that doesn't happen quickly enough in many, many cases. And that's a big, big problem.
Martin, you are such a wealth of knowledge and super connector in the ecosystem. Thank you. For folks who are interested in getting in touch with Armstrong International, feel free to email hubie@armstrongint.com. That's hubie@armstrongint.com. And now back to our LP interview.
What trends did you see? And this makes me think of something I recently read from one of our good partners, SVB, came out with their state of the market. And last year, the second half of 2023, they said that 1 in 4 funds that were raising or maybe raised were AI focused funds. So what trends have you seen?
Yeah, so first of all, I think it's super important to remember that generally differentiation as a VC is relatively tough. Kind of capital in a certain way is a commodity, and kind of when you talk about trends and differentiation, I think it's kind of important to note is like it's not that easy to differentiate, right? I think the the second thing, I think, how to frame it in terms of trends, I think it has gotten so much more important to show, not tell, really showing a track record, really showing your network, really showing kind of deals you've done and entrepreneurs you've worked with versus just spinning up kind of the same words that everybody is using, right?
Mm-hmm.
But having said all that, when you look at the trends, I would say verticalization is probably the most powerful one. I think we're probably past an opportunity for emerging managers to come in as a generalist at this stage. Not completely excluded if you have an amazing track record. Perhaps you come from a branded firm. You have some unique network, but in general, I would say this is probably much more an opportunity for a specialized climate fund, a specialized crypto fund, specialized deep tech fund, and partly also regional strategies. Kind of seen tons of people that focus on certain regions, if that is whole countries or kind of sub-regions within North America, et cetera. I would say, but in general, verticalization, both around categories as well as regions, is probably the biggest trend right now.
Do you think those will scale okay? Or do those serve you very well, but not necessarily the GPs forming them?
Yeah, I think it really depends. I think obviously the biggest challenge of vertically focused funds is the category you have been betting on doesn't run as long and as far as you thought, right? And you're stuck in an area that is not interesting enough and not growing as fast enough, right? The big advantage of a vertical fund is obviously you can go much deeper in terms of your network and your value add to your entrepreneurs. So it's a real trade-off. So I think the question is really, what is the underlying trend and how close is it to a generalist VC? So I would say when you think about climate and crypto and deep tech, these are actually areas that feel very large, lots of room to run, and very different to how a generalist VC thinks. That is probably a little bit less true. So in AI, AI, you would probably could argue it's an evolution of the current paradigm from internet to mobile to AI.
Mm-hmm.
Everyone going to have AI at some stage, so it's not going to be a differentiator, right? Most likely it's going to be harder to compete against generalist funds as an AI vertical fund. Crypto, climate, and deep tech feels very different in that way.
I'm intrigued that you're looking at climate right now, given that it feels like it has maybe peaked and is leveling out. What's your reasoning on how do you sort of think about some of these overhyped or trendy categories versus what are things you would want to be doing long term, both as a GP and a VC?
So first of all, I think you should never overthink that if you invest in the early stages or invest in emerging managers that invest in the early stages. Right? Reality is these are 10 to 15 year cycles. Like whatever was in last year or is in 2 years doesn't really matter per se. I think climate, first of all, I think it's a tricky area to invest in because it's underlying. There's so many different things from hard science, deep science to application layer, different business models, different regions, etc. But I think that the long-term view would be there's lots we have to figure out as humanity on the technology side to battle the climate crisis, and there will be lots of business opportunities to go after. It's certainly going to be a much bumpier road than investing in software, right? Which had a strong business model from the start across the board, much clearer to scale, was much more of a homogeneous market, etc. And so climate, you could argue it's going to be the returns for the winner is going to be very, very large, but there will be lots of losers that just not going to figure it out.
Most VCs haven't seen 200 GP decks, and they think they're very special because maybe they haven't seen those 200 GP decks.
In just 2 weeks.
in 2 weeks.
Currently fundraising.
Maybe most VCs haven't seen 200 founder decks in 2 weeks, but curious, this experience, how has it informed your own fund's strategy?
Listen, 2 takeaways. Decks are overrated. The more you see of them, the more generic they look. Right? And I'm just being taken back to our own fundraising in the past, and kind of you look at the deck and you put tons of work in the deck, and ultimately, to a certain extent, it's generic, right? And comes back to much more important these days is show not tell, and kind of a deck is an entry point, but ultimately it's really hard for anyone to take a decision on a deck. It's just not that differentiated. But I think more importantly for us, when you see how many emerging managers are raising right now, is ultimately kind of the reminder that we are competing in a hyper noisy competitive market, and as version 1, we need to evolve, and we need to kind of earn the right to be chosen as a partner for entrepreneurs on a daily basis. So, right, I think it's inspiration for us to step up our game, and kind of, I think we're always driven by that, but this is a great reminder of that the noise is even bigger, the competition is even bigger, and they're moving fast. So exciting times, I think, for VCs to continuously evolve the game and step up their game.
Since the tweet, you've published some takeaways and advice for emerging managers. Could you just give us kind of an overview of what stood out to you? And
yeah, I mean, listen, there's a few things I already mentioned in terms of kind of differentiation is generally tough. It is secondly super important to have to point out an investment track record. I think we've seen too many emerging managers that came from a pure operator background and invested perhaps a little bit too quickly over the last 2 or 3 years, and now struggled with portfolio construction and stuff like that. So pointing out your investing experience. I think that the 2 things on top of that I feel like are important to remember. The first one is a concept I call like kind of the minimum viable fund, right? So given that it's tough to fundraise right now, you might have an idea of what you want to raise, but perhaps you should start with like what you need to raise, right? Mm-hmm. And so it's not the want, but it's the need, and really thinking like, what is the smallest fund size you need to raise to prove out your strategy, right? And as an example would be as a seed fund, you don't need to have follow-on money to prove out your strategy. As a seed fund, it's all about, do you get in the most important deals? Do you get allocation in those? It's not about, can you optimize your follow-on strategy, right? So follow-on is kind of a nice to have. You need to have a fund size that lets you get into 20 or 25 seed investments with the right ownership stake, right? And then the last one is kind of less learned is just avoid kind of the bad doors, the decisions you take right now for short-term gain, but long-term just are the wrong decisions, right? And so I've seen a bunch of people that get approached when they're in kind of the most despair moment of fundraising, of taking on a partner that has on paper great fundraising experience. It has perhaps a good investment track record and helps with fundraising, but it's ultimately not the right partner to build that fund over the years. And while it might help you close that fund, you're going to regret it down the road because you have a partner that just is not aligned with you in terms of how you want to build a fund, what kind of investments we want to do. And so it might help you with that fund, but it doesn't really help you build a great fund down the road. The other thing I've seen a bunch of times is obviously LPs that want to anchor the fund, but want to take a big piece of the carry. And, in certain situations that might be okay, but if the carry is too big, and the carry you're giving up is too big, you set a precedent that's just very, very tough to recover from. So just be careful about the one-way doors that have just bad consequences in the long run.
And any tactics or things that you found for your own fundraising that you would pass along to emerging managers now that I believe you're on Fund 4?
Yeah, I mean, listen, it certainly changes from Fund 1 to Fund 4, hopefully, as you build out a track record and you build up an LP base. I think for Fund 1, I think the most important thing is just you show fundraising traction, right? And that is like in when you raise for a company, is like have the target size rather smaller than larger, right? Show very quick traction towards a 40 or 50% commitment, right? And from there on, it really gets much easier. The challenge is just LPs in general have no rush. They have no urgency to kind of act. And unless you, and there's lots of LPs, to be honest, that jump on a bandwagon once it's about to leave the station, right? And so you have to make sure that they feel this is about to leave the station, and you have to kind of get them to that point, right? And so I just feel it's really tough if somebody has to start with a very large fund and a target they want to raise, have no traction, and they start from scratch in the public, and 6 months later you still have not much traction. It's just very, very tough.
That makes me think of a quick story. I was hearing from another emerging manager that, okay, this is VC hearsay, but have some proof points that it happened. But she was told that this was probably in 2015, emerging managers at the time starting a growth fund, went to LPs and said, after the meetings, LPs were saying, oh, you guys are a little bit early. We'd love to be in touch for this fund too. And their strategy was like, oh, I apologize. Sorry. If you don't invest now, you won't be invited for the next fund. And they were able to get some of those people to invest. Now that's a way to create FOMO, and that's risky.
Listen, if
as
you
well.
have the confidence of doing it, like aggressive fundraising strategies can work out, but you have to have the confidence, understanding, and the plan B to do all that, right?
Yeah. You seem like, Boris, a very thoughtful individual that uses thesis as well, and thinking about your criteria of what even GPs you were looking for. After reviewing all these decks, do you still feel there's a certain strategy that you wanted to see that's not really out there?
I would say it's less about the strategy than more about a mindset. There's not enough conviction in this market and among VCs, right? Lots of people always talk about contrarian thinking, but then they jump on the next momentum deal. I think like history has always shown that the more conviction you have, the more unique you are in your investment thesis and your investment approach, and you keep it up over the long term, the better you will do, right? And I think in general, and it's not only in VC, but I think in general, investors, and it's the normal human mindset. It's always easier to follow someone else or follow a trend or follow a category or back some momentum, right? But I wish there were people out there that had a very clear, concise, contrarian investment strategy, and we're okay to kind of go against the mainstream for a long period of time.
I really appreciate that. Conviction is so key. And it's so surprising sometimes to me that individuals dedicate their careers to one of the most risky asset classes, yet want to treat it like it's private equity and can be financial engineering and moving with the
Yeah.
crowds when there's no data that proves that's how you'll actually have great, realized returns.
Yeah, correct. I mean, I always when people ask me about kind of how quickly do you see success and how do you look at things, I always cite like out of our fund 1 and 2, which is a 2012 and 2014 vintage, and a total of about 50 portfolio companies, right? So 6 will drive ultimately 90%, 95% of the returns, right?
Mhm.
And out of these 6, there's 2 that pivoted in between, right? There's 2 that for 5 to 6 years had no kind of positive feedback loop from the financing market. They had a really tough time raising money, and on paper you wouldn't have seen it. That these are great companies, and they were like in tough categories, what were perceived tough categories, or in a location that wasn't really that hot, and it just shows that kind of these outliers, these success stories, they usually don't follow a normal path, right? And I think people trying to jump way too quickly onto these mainstream signals, and ultimate success looks very different, and it's not that kind of straightforward path that people usually kind of think they're investing against.
Did you personally have to really roll up your sleeves and help? I'm curious about those 2 dark horses that others didn't quite understand from, as you said, on paper, what they looked like, that they were worth committing more to. Did you? I'm curious if you ended up having to be the one with the conviction to keep those alive.
Yeah, I mean, certainly not alone. I think there were a few co-investors that had the same conviction, right? But we certainly kept on financing these companies based on progress, right? And ended up with very large stakes in these companies because nobody else wanted to finance them, right? But it wasn't like a single-handedly effort of version 1. There were other people involved. But ultimately, I think if you have that conviction, if you're that close to the company, and you see the progress they're making on a purely business building side, right? You can be relaxed and wait for the market to come, right? And suddenly define as a hot category or a hot startup or a location you can build a company from, that can be really important.
Lastly, Boris, want to ask, would you like any more intros to managers? And
Sure. Always.
Are you done? Have you found your 3?
No, I'm not done. I mean, ultimately, I committed to more than the 3 to 4 I had originally set out, because I just got a fire hose of intros and actually, kind of got to know some really great emerging managers. So I'll continue to invest in that space, and this is not a one-time exercise; it's ongoing. It feels like it has crystallized around this one tweet and kind of a month-long period, but obviously, there's emerging managers at any stages throughout the year that are raising, and so I'm going to continue to invest in that space. So please send them my way.
Awesome. Well, Boris, we want to thank you not only for being on the podcast, but also just the gems that you've been providing and showing as an established fund manager how to pay it forward. I think that speaks volumes to who you are and the change you want to see in the industry. So we just want to thank you for everything you do and for being on the podcast.
Thanks for having me. That was a lot of fun.
See you later, alligator.
After Portfolio Tile, investing with a smile.